Most people believe financial crises are accidents. Sudden failures. A bubble bursts. A bank fails. A market crashes. And afterward, we tell ourselves the same story every time. No one saw it coming. Again and again, across centuries, across empires, across currencies and continents, crises follow a pattern so consistent it begins to feel intentional. Debt expands. Risk concentrates. Complexity hides fragility. And when the system finally breaks, the consequences are never evenly shared. Some lose everything. Others gain control. The unsettling question is not whether crises happen. It is why they always seem to arrive at moments when power is ready to be reorganized. Long before modern finance, rulers understood something fundamental about human behavior. People resist control in stable times, but surrender it during emergencies. When survival feels threatened, populations accept rules they would otherwise reject. They tolerate authority they would normally oppose. They trade autonomy for security. Financial crises exploit this instinct with ruthless efficiency. They were recurring features of economic life. Farmers borrowed seed and tools during hard seasons. Merchants borrowed silver to finance trade. Temples and palaces extended credit, recorded obligations, and charged interest. Over time, debts accumulated faster than harvests or wages could repay them. Eventually, entire populations became trapped. Land was seized. Families were sold into debt bondage. Social unrest followed. Rulers learned quickly that unmanaged debt led to rebellion. So they invented a solution that appears generous but is deeply revealing: periodic debt forgiveness. Debt jubilees were not acts of mercy. They were acts of control. By resetting obligations, kings restored order, reasserted authority, and prevented collapse. The crisis created the justification. The ruler delivered the solution. Power was reinforced. The lesson was clear. Crisis was dangerous, but controlled crisis was useful. As economies grew more complex, crises evolved alongside them. When money moved from temples to private lenders, from palaces to banks, the power to create and resolve crises followed. By the late Middle Ages, European banking families had learned how to weaponize instability. Lending to monarchs funded wars. Wars drained treasuries. Defaults wiped out smaller creditors, while politically connected financiers were compensated with land, titles, or monopolies. Public debt became a permanent feature of governance. Crises were no longer interruptions to power. They became instruments of it. The birth of central banking formalized this relationship. Institutions like the Bank of England were created not to prevent crises, but to manage them in ways that preserved the state and its financiers. When governments overspent, central banks stabilized borrowing. When markets panicked, liquidity was injected. When inflation rose, wages lagged behind prices. Every intervention solved one problem while creating another. The Industrial Revolution magnified this dynamic. Capital markets expanded. Railroad booms collapsed. Stock manias imploded. Banking panic swept through cities. Each time, the pattern repeated. Those closest to credit survived. Those dependent on wages suffered. Regulation followed only after damage had been done. By the early 20th century, crises were no longer local events. They were systemic shocks capable of reshaping entire societies. The Great Depression was not simply a market failure. It was a mass psychological event. Confidence collapsed. Savings vanished. Unemployment soared. Governments expanded power dramatically in response. Emergency programs were introduced. Financial oversight increased. Monetary systems were restructured. And citizens accepted it, all because the alternative felt worse. Crisis legitimized transformation. World War II extended this logic even further. Total war required total economic control. Governments rationed goods, directed production, fixed prices, and coordinated labor. After the war, much of this control quietly remained. Welfare systems expanded. Central banks gained influence. International financial institutions were born. The post-war financial order was presented as stability. But stability came at a price: permanent debt, permanent intervention, permanent surveillance of economic activity. Crises did not disappear. They were postponed, redistributed, and managed. As the 20th century progressed, financial systems became more abstract. Money detached from physical constraints. Credit expanded faster than production. Risk was sliced, packaged, and sold. Complexity became camouflage. By the late 1990s, few people truly understood how the system worked, not even those running it. Derivatives multiplied. Balance sheets grew opaque. Shadow banking flourished beyond regulation. This was not an accident. Complexity protects power. When systems are too intricate to understand, accountability dissolves. The crisis of 2008 exposed this reality in brutal clarity. They chose rescue. Trillions were created overnight. Institutions deemed too big to fail were saved. Executives kept bonuses. Shareholders were protected. Meanwhile, households lost homes, pensions, and years of income. Regulation increased, but in ways that entrenched existing giants. Once again, crisis justified concentration of power. What followed was not recovery, but dependence. Governments learned that debt could be monetized. Central banks learned they could shape reality by shaping expectations. Crisis was no longer an emergency, it became a policy tool. The pandemic accelerated this transformation dramatically. Within weeks, economies were shut down, supply chains froze. Governments issued emergency decrees. Central banks unleashed stimulus on a scale never seen before. Entire populations accepted digital tracking, emergency powers, and economic restrictions in exchange for stability. Money flowed directly from central banks to markets. Asset owners grew wealthier. Workers became more dependent on state support. Energy crises reshaped consumption. Inflation eroded savings. Interest rate hikes strained households while stabilizing currencies. Debt servicing costs rose, making governments more reliant on financial markets. Crisis layered upon crisis. What emerges from this pattern is not chaos but design. Crises serve multiple functions simultaneously. They discipline populations. They consolidate institutions. They erase old obligations while creating new ones. They reset narratives about responsibility and blame. Most importantly, they redefine what is considered normal. Measures once seen as extraordinary become permanent. Surveillance becomes security. Control becomes stability. Dependence becomes safety. Financial crises, in this sense, are not failures of the system. Those with access to liquidity survive volatility. Those without it absorb the losses. Debt compounds. Assets appreciate. Wages stagnate. Crisis accelerates trends that already exist. Today, crises are no longer purely financial. They are hybrid events: economic, political, technological, and psychological. Currency instability triggers social unrest. Energy shortages reshape alliances. Cyber threats justify surveillance. Climate risk informs financial policy. Everything becomes interconnected. This interconnectedness creates fragility, but also opportunity. When systems are fragile, fear spreads quickly. And fear is the most powerful economic force of all. Fear changes behavior faster than incentives. It makes people comply without coercion. It lowers resistance to policies that would otherwise be rejected. Crisis creates urgency. In that suspension, power moves. The unsettling reality is not that crises happen, but that we have built a world that requires them to function. Debt-based systems need resets. Asset markets need volatility. Political authority needs emergencies. Control needs justification. Crisis provides all of it. As long as economies are built on leverage, scarcity, and unequal access to liquidity, collapse will remain inevitable. And as long as collapse can be managed, it will remain useful. This brings us to the edge of something new. Because the tools of crisis management are evolving. Digital currencies, programmable money, real-time surveillance of transactions, algorithmic risk controls, behavioral nudges embedded in financial infrastructure. The next crisis may not look like a collapse at all. It may arrive as a solution, a promise of stability, a guarantee of access, a system that prevents failure by removing choice. It is that crises transform them. And the more often transformation occurs, the more power concentrates in fewer hands. Understanding this does not mean rejecting finance. It means recognizing its logic. Money is not neutral. Crises are not accidental, and control rarely announces itself honestly. The real danger is not the next crash. It is how prepared the system already is to use it. If you want to understand the future of money, you cannot look only at markets. You must look at moments of fear, at moments of collapse, at moments when rules change overnight. And what comes next depends on how much control we are willing to surrender in exchange for stability. In the next episode, we will explore where this trajectory leads toward a world where financial control is total, seamless, and invisible. A system that does not wait for crises, but prevents resistance before it begins. This is not speculation. It is already being built. If you want to understand what is coming, stay with us. Welcome to the dark economy.